Here's a fact that will shake you. The average investor earns only 2.9% returns, while the stock market returns 7.5% over the same period. According to research from J.P. Morgan covering 2001 to 2020, most people destroy their own wealth, not because stocks don't work, but because of their own behavior. This is a full 1-hour course. By the end, you'll understand exactly how stocks build wealth, why most people fail, and the simple steps that separate millionaires from everyone else. No complicated finance degrees needed. Over the next 60 minutes, I'm going to show you research-backed strategies that have created thousands of millionaires. People who started with almost nothing. Janitors who died with $8 million. Teachers who retired with $2 million. Regular people, just like you. And here's the key. It's not about picking the right stocks. It's about something far simpler. Something that anyone, regardless of education or income, can do starting today. So stay until the end because the final steps will change everything you thought you knew about building wealth. Let me give you a number that should make you stop everything. The U.S. stock market has never, let me repeat that, never lost money over any 20-year period in history. According to data compiled by the Measure of a Plan, analyzing 150 years of market data, even during the Great Depression, world wars, and financial crises, patient investors always came out ahead. Think about that for a second. Your grandfather who bought stocks during World War II made money. Your mother who invested during the 2008 crash made money. The person who bought stocks right before COVID hit in March 2020, if they held for 20 years, the data says they'll also make money. The stock market has averaged approximately 10% annual returns since 1926, according to Dimensional Fund Advisors. Not 2%, not 5%, 10% every single year on average. That's the power sitting right in front of you. But wait, if the market returns 10%, why does the average investor only get 2.9%? What's going wrong? I'll reveal the exact reasons later in this course, and trust me, once you understand this gap, you'll never invest the same way again. Albert Einstein once called compound interest the eighth wonder of the world. And here's why. When you invest money, you earn returns. But then, those returns also earn returns. And those returns earn even more returns. It's like a snowball rolling down a mountain, getting bigger and bigger. Here's a real example that will blow your mind. According to research from the Money Guy Wealth Multiplier, if you invest $500 at age 20 at 10% growth, by age 60, it becomes $26,850. That same $500 without compounding? Just $2,500. The difference is more than 10 times. This is why starting early matters so much. A dollar invested at age 20 is worth far more than a dollar invested at age 40. Time is literally your greatest asset in building wealth. The rule of 72 is your best friend here. To figure out how long it takes to double your money, divide 72 by your interest rate. At 10%, your money doubles every 7.2 years. At 7%, every 10 years. According to Carson Wealth Research, at a 9% compounding rate over 40 years, $50,000 becomes $1.6 million. Just from sitting there, doing absolutely nothing. Now, here's where most people get confused. They think building wealth means picking the right stocks, finding the next Amazon, the next Tesla, the next Apple. But the research says something completely different. According to S&P's SPIVA research, roughly 90% of professional active fund managers underperform their index over a 10-year period. These are people with fancy degrees, billions in resources, and armies of analysts. And 9 out of 10 of them can't beat a simple index fund. So what's an index fund? It's a basket that holds all the stocks in a market index. Instead of trying to pick winners, you own everything. The S&P 500 Index Fund? It owns the 500 biggest American companies. All of them. No guessing required. The research from Morningstar, published in August 2025, found that only 33% of actively managed funds beat their index counterparts. And here's the kicker: fees are the main reason. Index funds charge around 0.11% annually. Active funds? 0.59%. That difference eats into your wealth over decades. Let me show you just how powerful this data is. Over 15 years, market indexes outperformed over 80% of active funds in every single category that SPIVA tracks, from small companies to large companies to real estate. So imagine you're choosing between a fancy hedge fund manager who charges 2% in fees and promises to beat the market, versus a boring index fund that charges 0.05% and just copies the market. The data overwhelmingly says, take the boring option. Your future self will thank you. Why do people still choose active funds then? Because we're human. We want to believe someone special can see the future. We want the excitement of picking winners. But wanting something doesn't make it statistically likely. According to research published by London Business School, 65% of actively managed large-cap U.S. equity funds underperformed the S&P 500 in 2024 alone. And that's during volatile times when active managers claim they have an advantage. Let's talk numbers. Real, historical numbers that you can verify yourself. The S&P 500 has averaged about 10% annually over long periods before inflation. After inflation, around 6.5% to 7%. This comes from NYU Stern research going back to 1928. Now, 10% might not sound exciting. You see headlines about stocks doubling or tripling overnight, crypto making millionaires in months. But here's what that 10% actually means over time. If you invest $500 per month at 10% annual returns starting at age 25, by age 65, you'd have approximately $2.6 million. Most of that isn't even money you put in. It's compound growth doing the heavy lifting. According to data from Trade That Swing, the historical average yearly return of the S&P 500 is 9.466% over the last 150 years. Adjusted for inflation with dividends reinvested, the 30-year average is 7.718%. These aren't opinions. These are facts spanning over a century. Now we get to the real problem. Remember that gap I mentioned? Average investor gets 2.9%, while the market returns 7.5%? Here's exactly why. According to JP Morgan research, most investors buy high when they're excited and sell low when they're scared. They chase returns when stocks are already expensive. They panic and sell when stocks are cheap. It's backwards. Think about it like shopping for groceries. If rice went on sale for 50% off, you'd buy more, right? But when stocks go on sale, when prices drop 20%, 30%, 40%, most people run away. They sell everything. It makes no sense logically, but fear isn't logical. The JP Morgan Chase Institute found that investment flows increase when markets are up, showing a pattern of returns chasing. People invest more when stocks are expensive and already risen. This behavior alone destroys trillions in potential wealth every decade. Here's a stat that should stop you from ever trying to time the market again. According to JP Morgan research, over the past 20 years, 7 of the stock market's 10 best days occurred within just 15 days of the 10 worst days. Let that sink in. The best days happen right next to the worst days. If you panic and sell during a crash, you almost certainly miss the recovery days that follow. So imagine you're watching the news. Markets are crashing. Everyone's panicking. You sell everything to wait it out. But then, 3 days later, the market shoots up 8% in a single day. You missed it. You were sitting on the sidelines holding cash. The same JP Morgan data shows that if you stayed fully invested from 2004 through 2024, your average annual return was 10.5%. But if you missed just the 10 best trading days, your return drops to 6.2%. Miss the best 20 days? Just 3.6%. Time in the market beats timing the market every single time. Now, let me teach you one of the most powerful strategies for regular people: dollar cost averaging. This means investing a fixed amount at regular intervals, every month, every paycheck, regardless of what the market is doing. Why does this work? Because you automatically buy more shares when prices are low and fewer shares when prices are high. You remove emotion from the equation completely. According to research from Vanguard, while lump sum investing technically outperforms dollar cost averaging 68% of the time, DCA has a crucial advantage. It helps you actually stay invested. The best strategy is the one you'll actually stick with. Let's say you get $500 from your paycheck every month. You set up automatic transfers to your brokerage account. Rain or shine, bull market or bear market, that money goes in. After 10 years, 20 years, 30 years, you've built massive wealth without ever having to make a single stressful decision. Now, I need to be honest with you about something. The research actually shows lump sum investing, putting all your money in at once, outperforms dollar cost averaging most of the time. Northwestern Mutual research analyzing rolling 10-year returns found that investing a lump sum all at once generated better cumulative total returns than dollar cost averaging almost 75% of the time, regardless of asset allocation. So why did I just tell you about dollar cost averaging? Because it doesn't matter which strategy is mathematically optimal if you can't emotionally stick with it. Lump sum requires courage. You need to invest everything and then not touch it for decades. Here's the real advice. If you suddenly receive a large sum, an inheritance, a bonus, selling a house, the data says invest it all immediately. But if you can't do that without panicking, then spread it out over 3 to 12 months. Getting your money invested somehow is better than keeping it in cash forever. Before we go any further, we need to discuss something critical. You should not invest in stocks until you have an emergency fund. Period. End of discussion. According to research from Vanguard in 2025, having $2,000 in emergency savings results in a 21% increase in financial well-being, and having 3 to 6 months of expenses saved is linked to an additional 13% increase. Vanguard's research found that $2,000 in emergency savings can be as powerful as having $1 million in assets for your overall financial well-being. That's incredible. A small cushion can transform your entire financial life. Why does this matter for investing? Because without an emergency fund, you'll be forced to sell your investments when life happens, when your car breaks down, when you lose your job, when medical bills arrive. And that selling usually happens at the worst possible time. The 2024 Federal Reserve SHED survey found that only 55% of Americans have set aside money for 3 months of expenses. That means half the country is one emergency away from financial disaster. Experts recommend saving 3 to 6 months of essential expenses. Not your total income, your essential expenses: rent, food, utilities, insurance. Add those up, multiply by 3 to 6, and that's your target. For example, let's say your essential monthly expenses are $2,400. 3 months would be $7,200. 6 months would be $14,400. Start by aiming for the lower number, then build up over time. According to Bankrate's 2026 Emergency Savings Report, only 47% of Americans can cover a $1,000 emergency expense from savings. The rest would need to borrow, sell something, or go into debt. Don't be part of that statistic. Build your emergency fund before you start investing heavily. Here's another rule that many people ignore. If you have high interest debt, you should probably pay that off before investing in stocks. Think about the math. Credit cards charge 20 to 25% interest. The stock market historically returns about 10%. If you invest while carrying credit card debt, you're essentially borrowing at 25% to earn 10%. That's a losing trade. The exception is low-interest debt. Your mortgage at 3 to 4%? Keep paying minimum and invest extra money. Student loans at 5%? It's a toss-up. But credit cards? Pay those off first. Every dollar you put toward that debt earns you a guaranteed 20% plus return through avoided interest. Now, employer matching is different. If your employer offers a 401k match, that's free money. Take the match even while paying off debt. A 100% return on your contribution beats paying off any debt. Let me tell you about Ronald Reed. He was a janitor in Vermont. He pumped gas. He worked as a maintenance worker. He earned a modest salary his entire life. When he died in 2014, people were shocked. According to multiple financial sources, he had accumulated $8 million. $8 million from a janitor. How did he do it? He invested consistently in blue-chip stocks for decades. He lived below his means. He let compound interest work its magic. He never panicked. He never sold during crashes. He just kept going. You don't need a six-figure salary. You don't need special knowledge. You don't need connections. You need time, consistency, and patience. Those three things beat everything else. Now let's talk about something that scares most people away from stocks. Risk. Yes, stocks can lose value. Yes, there will be crashes. Yes, you will see red numbers on your screen. But here's the thing. Risk and return are connected. You cannot get high returns without accepting some risk. A savings account is safe, but pays almost nothing. Stocks are risky, but pay significantly more over time. According to Dimensional Fund Advisors research, while rolling 12-month stock returns have varied from negative 37% to positive 53% since 1950, the picture changes dramatically over longer periods. Over any 20-year period in U.S. stock market history, stocks have never produced negative returns. The key word is time. Short-term, risky. Long-term, historically reliable. The S&P 500 has suffered an average intra-year pullback of about 14% over the past 4 decades, according to J.P. Morgan data. That means almost every year, stocks temporarily drop by double digits. Imagine you check your investment account and see it's down 15%. Your heart races. You think, should I sell? But this happens almost every year. It's normal. It's expected. It's the price you pay for long-term growth. Despite those pullbacks, the index still managed to post a positive return in 31 of the past 40 years. The drops are temporary. The growth is permanent. If you can train yourself to see drops as normal, you've won half the battle. The people who panic during drops are the ones who earn 2.9%. The people who stay calm and continue investing are the ones who capture the full 10%. Which one will you be? Let me show you something that seems small but is huge. Fees. The money you pay to own investments. Most people ignore fees completely. Big mistake. According to research from the SEC, an investor with $100,000 who earns 4% per year and pays 0.25% in fees would have $208,000 after 20 years. The same investor paying 1% in fees? Only $179,000. That's $29,000 lost, just to fees. Think about what you could do with $29,000. A new car? A down payment on a house? A year of college tuition? All gone, paid to fund managers who probably underperform the market anyway. Index funds at places like Vanguard or Fidelity charge as little as 0.03% to 0.05%. That's basically nothing. Meanwhile, actively managed funds often charge 0.5% to 1.5% or more. Over 30 to 40 years of investing, that difference compounds into hundreds of thousands of dollars. Another advantage of index funds that people overlook: tax efficiency. When a fund manager constantly buys and sells stocks, it triggers taxable events. You owe money to the government on those gains. Index funds, by contrast, rarely sell anything. They just hold the same stocks that are in the index. This creates fewer taxable events and keeps more money in your pocket. According to Vanguard's comparison research, actively managed funds
often have more taxable capital gains because the manager trades more frequently. This makes them less tax efficient, especially in regular brokerage accounts. So you're not just losing to underperformance and higher fees, you're also losing to higher taxes. 3 strikes against active management. Index funds win on all 3 counts. Now let's talk about the most powerful tools for building wealth: tax-advantaged retirement accounts. These are like legal cheat codes that the government gives you. A 401k or 403b is offered through your employer. You contribute pre-tax money, which lowers your current tax bill. The money grows tax-free inside the account. You only pay taxes when you withdraw in retirement. An IRA, or individual retirement account, works similarly, but you open it yourself. A traditional IRA gives you a tax deduction now. A Roth IRA uses after-tax money but grows completely tax-free forever. According to research on compounding, tax-advantaged accounts allow investments to grow tax-deferred or tax-free, further accelerating the compounding effect. This is like adding rocket fuel to your wealth-building engine.
If your employer offers 401k matching, listen carefully. This is the closest thing to free money you will ever receive in your life. Here's how it works. Your employer says, "We'll match 50% of what you contribute, up to 6% of your salary." So, if you earn $50,000 and contribute $3,000, 6%, your employer adds another $1,500. That's a 50% instant return on your money. There is no investment in the world that guarantees a 50% or 100% return, but employer matching does. Yet millions of Americans don't take full advantage of it. They're literally leaving free money on the table. Before you do anything else with your money, before paying extra on debt, before investing in a regular brokerage account, max out your employer match. Always. No exceptions. This is non-negotiable. Should you choose Roth or traditional? This is one of the most common questions new investors ask. The answer depends on your situation. Traditional accounts, you get a tax break now. Money goes in pre-tax, you pay less today, but you'll pay taxes when you withdraw in retirement. Good if you're in a high tax bracket now and expect to be in a lower one later. Roth accounts, you pay taxes now. No deduction today, but all growth is completely tax-free. When you retire and pull money out, you owe nothing. Good if you're in a low tax bracket now and expect higher taxes later. For most young people, Roth is typically better. You're probably earning less now than you will later. Pay the taxes while they're cheap. Let decades of growth happen tax-free. Your 60-year-old self will thank your 25-year-old self. There are limits to how much you can put in retirement accounts each year. Knowing these numbers is important. For 2025 to 2026, 401k contribution limits are typically around $23,000 per year, with an additional catch-up contribution if you're over 50. IRA limits are around $7,000 per year. These numbers adjust for inflation over time. If you can't max these out, don't worry. Contribute what you can. Something is infinitely better than nothing. Even $50 per month is building your future. But here's the strategy for high earners. Max your 401k first because of the higher limit. Then max your IRA. Then, if you still have money to invest, use a regular taxable brokerage account. This order maximizes your tax advantages. Now, let's design an actual portfolio. I'm going to make this as simple as humanly possible. Ready? You could build substantial wealth with just 3 funds. A U.S. stock index fund, an international stock index fund, a bond index fund. That's it. 3 funds can cover the entire global economy. For someone in their 20s or 30s, you might hold 80 to 90% stocks and 10 to 20% bonds. As you get older and closer to retirement, gradually shift more toward bonds for stability. This is called a 3-fund portfolio, and financial experts love it. It's diversified across thousands of companies, multiple countries, and different asset types. It requires almost no maintenance, and it costs almost nothing in fees.
If even 3 funds seems like too much, there's an even simpler option: target date funds. These are single funds that automatically adjust over time. Here's how they work. You pick a fund with your expected retirement year in the name. Target date 2055, for example. The fund starts aggressive with mostly stocks, then automatically becomes more conservative as the date approaches. According to JP Morgan research on retirement planning, target date funds are excellent tools for keeping investors on track because they remove the need for manual decisions. One fund. Set it and forget it. Automatic rebalancing. Automatic risk adjustment. Perfect for people who want wealth building on autopilot. Your only job is to keep contributing money. You've probably heard the phrase, "Don't put all your eggs in one basket." In investing, this is called diversification, and it's critical. Diversification means owning many different investments so that if one fails, you don't lose everything. If you own 500 stocks and one goes bankrupt, it barely affects you. If you owned only that one stock, you're wiped out. Imagine you put all your money into one exciting tech company. Maybe it's the next Apple, or maybe it's the next Enron. You're gambling. But if you own an index fund with 500 companies, some will fail, but the winners will carry the whole basket forward. This is why index funds are so powerful for regular investors. Instant diversification. One purchase gives you ownership in hundreds or thousands of companies. Professional-level diversification without professional-level money. Should you invest only in U.S. stocks, or include international stocks too? This is a genuine debate among experts. The U.S. stock market has outperformed international markets for much of the past decade. This makes some people say, just invest in America. But here's the problem. Past performance doesn't guarantee future results. There have been extended periods where international stocks crushed U.S. stocks. The 2000s were one such decade. If you only owned U.S. stocks during that time, you missed out on significant gains elsewhere. Most experts recommend holding some international exposure, maybe 20 to 40% of your stock allocation. This provides geographic diversification. If America struggles, your entire portfolio doesn't sink. Think of it as insurance. Now let's talk about the boring part of investing: bonds. A bond is essentially a loan you make to a company or government. They pay you interest, then return your principal at maturity. Bonds are less volatile than stocks. They don't grow as much, but they don't crash as hard either. This is why older investors hold more bonds. They need stability since they don't have decades to recover from crashes. According to historical data from NYU Stern, bonds have historically returned about 5 to 6% annually compared to stocks at 9 to 10%. Less reward, but also less risk. Your bond allocation should generally increase as you age. A common rule is to hold your age in bonds. So at 30, hold 30% bonds. At 60, hold 60% bonds. This isn't perfect for everyone, but it's a reasonable starting point. Over time, your portfolio drifts away from your target allocation. If stocks have a great year, suddenly you might be 85% stocks when you wanted 75%. This is where rebalancing comes in. Rebalancing means selling some of what has grown and buying more of what hasn't to return to your original target. It forces you to buy low and sell high, automatically. You should rebalance roughly once per year. Check your allocations, see if they've drifted more than 5% from your target, and adjust if needed. This keeps your risk level consistent with your goals. With target date funds, rebalancing happens automatically. Another reason why those funds are excellent for hands-off investors. Let me repeat something so important I need to say it again. Time in the market beats timing the market. Every single time. According to the JP Morgan data we discussed earlier, staying fully invested produced 10.6% annual returns, while trying to time the market and missing the best days produced only 6.4%. Think about what timing the market really means. You need to be right twice. You need to know when to get out and then when to get back in. Miss either decision and you lose money. Professional fund managers with billions of dollars and armies of analysts can't do this consistently. What makes you think you can? The humble, boring approach of staying invested beats the exciting approach of trying to outsmart the market. Here's one of the most valuable things I can teach you. Stop watching financial news daily. Seriously, turn it off. Financial news exists to create drama. Headlines scream about crashes, bubbles, disasters, and panics because fear generates clicks. But reacting to daily news destroys investor returns. Remember, over any 20-year period, the stock market has never lost money. But in any given week or month, it fluctuates wildly. News focuses on the short-term noise, not the long-term signal. Check your investments quarterly at most. Annually is even better for some people. The more you look, the more tempted you are to make emotional decisions. Ignorance, in this case, truly is bliss. Warren Buffett, one of the greatest investors of all time, once said his favorite holding period is forever. Think about what that means. He doesn't buy stocks planning to sell them next year. He buys businesses he wants to own for the rest of his life. This mindset completely changes how you invest. When you own an index fund, you're not betting on stock prices going up tomorrow. You're owning a piece of the global economy, human innovation, corporate profits, economic growth. These things have trended upward for centuries. Your job is to keep contributing money regularly, reinvesting dividends, and not panicking during downturns. Do these three things for 30 to 40 years, and you'll almost certainly build significant wealth. Let me explain something that many new investors overlook. Dividends! Many companies pay a portion of their profits to shareholders as cash payments called dividends. When you receive a dividend, you have two choices. Take the cash and spend it, or reinvest it to buy more shares. For wealth building, always choose reinvestment. According to historical data, a significant portion of stock market total returns comes from reinvested dividends, not just price appreciation. Missing this component drastically reduces your long-term wealth. Most brokerage accounts let you set this to automatic. Enable dividend reinvestment, or DRIP, and forget about it. Every dividend payment buys you more shares, which produce more dividends, which buy more shares. The compounding cycle continues. Here's why keeping your money in cash is actually losing you money. Inflation. Every year, prices rise about 2 to 3% on average. Your dollars buy less and less over time. $1 in 1990 is worth only about 50 cents in today's purchasing power. If you kept cash under your mattress for 35 years, you didn't preserve your wealth. You lost half of it. Stocks, historically, have returned about 7% annually after inflation, according to research from McKinsey. They're one of the best inflation hedges available to regular people. This is why not investing is actually the risky choice. You might feel safe with cash, but inflation is silently eating your wealth every single day. Investing in stocks protects your purchasing power over the long term. We talked about building an emergency fund. Now let's talk about maintaining it. Life happens. You'll use your emergency fund eventually. And that's okay. That's what it's for. But when you dip into it, you need to replenish it as soon as possible. Make refilling your emergency fund a top priority after any emergency. According to Vanguard's guidance, after you use your emergency fund, get back on your budget and savings schedule immediately. The fund is only useful if it's funded. A good rule is to pause extra investment contributions temporarily while rebuilding your emergency fund. Once it's refilled, resume normal investing. This keeps you protected for the next unexpected event. Here's something that destroys wealth for millions of high earners: lifestyle inflation. You get a raise, and your spending increases to match. You never get ahead. When you make $50,000, you spend $48,000. When you make $75,000, you spend $73,000. When you make $100,000, you guessed it, You spend $98,000. Where did all your money go? The secret of wealth builders is to increase savings percentage as income grows, not spending. When you get a raise, invest at least half of it. Let your lifestyle improve a little, but let your investments improve a lot. People with modest incomes and modest lifestyles often retire richer than high earners with expensive tastes. Remember Ronald Reed, the janitor? $8 million. Meanwhile, some doctors and lawyers die broke. Human willpower is limited. We get tired, we forget, we procrastinate. That's why automation is your best friend in building wealth. Set up automatic transfers from your checking account to your investment accounts. Set them for the day after payday. Make it happen before you have a chance to spend the money. As the self-made millionaire Max Williams said in his interview with Go Banking Rates, automating savings and investments removed the temptation to spend that money elsewhere and ensured steady wealth building over time. When investing is automatic, you don't need discipline or motivation. The money moves whether you remember it or not. This simple trick removes human weakness from the equation entirely. Here's a principle that changed millions of lives. Pay yourself first. Before you pay bills, before you buy groceries, before you do anything, fund your investments. Most people pay everyone else first: landlord, credit cards, utilities, and invest whatever's left over. There's never anything left over. Something always eats the remaining money. Flip the script. Investment goes first. Then you pay bills with what remains. You'll be surprised how quickly you adapt. You find ways to live on less because you have to. This is what automatic investing accomplishes. The money is gone from your checking account before you can spend it. You naturally adjust your lifestyle to what remains. I want to return to one of the most powerful statistics in all of investing. Over 150-plus years of stock market history, according to Measure of a Plan research, there has never been a 20-year period with negative returns. Not the Great Depression, not World War I or II, not the dot-com crash, not 2008, not COVID, never. 0 times. This tells you something profound. If you have a 20-year time horizon, if you're investing for retirement decades away, historically, you've been guaranteed positive returns. Not promised, but historically guaranteed. The only way to lose in the stock market long-term is to panic and sell during a downturn. If you can simply not sell, if you can ride out the storms, the data says you'll be fine. Maybe you're watching this at 40 or 50 and thinking, I've wasted so much time. I want to tell you something important. It's never too late to start. Ever. Yes, starting at 25 is better than starting at 45, but starting at 45 is infinitely better than never starting. You still have 20-plus years until traditional retirement. That's plenty of time. According to research from financial advisors, compound interest can significantly grow wealth even starting at 50, with 15 to 20 years until retirement. The best time to plant a tree was 20 years ago. The second best time is today. Don't let regret about the past prevent action in the present. Start now with whatever you have. You don't need thousands of dollars to start investing. Many brokerages now have no minimum investment requirements. You can start with literally $1. Let's do some math. $100 per month invested at 10% annual returns. After 10 years, about $19,000. After 20 years, about $69,000. After 30 years, about $197,000. Just from $100 per month. Can you find $100 per month? That's about $25 per week. The cost of eating out a couple times. A streaming subscription you don't use. A phone plan downgrade. Small changes unlock life-changing wealth over time. Don't wait until you have more money. The habit of investing matters more than the amount. Start with $50 if that's all you have. The muscle memory of regular investing is worth more than any dollar figure. Let's quickly review the main account types you'll encounter. This sounds complicated, but it's actually simple. 401k or 403b. Employer-sponsored retirement accounts. Pre-tax contributions, tax-deferred growth, taxed at withdrawal. Often includes employer matching. IRA, individual retirement account. Traditional gives tax deduction now, Roth gives tax-free growth. You open this yourself at any brokerage. Brokerage account, regular taxable account. No tax advantages, but also no restrictions. You can withdraw anytime. Use this after maxing retirement accounts. The order of priority: first, get your employer 401k match. Second, max your IRA. Third, max your 401k. Fourth, use taxable brokerage. This order maximizes tax efficiency. Where should you actually open these accounts? There are many excellent options. Vanguard, Fidelity, Schwab, and others are all reputable and low cost. What matters most? Low fees, good customer service, easy-to-use interface, access to low-cost index funds. All the major brokerages offer these now. Honestly, the differences between top brokerages are minimal. Don't overthink this decision. Pick one, open an account, and start investing. Taking action matters more than finding the perfect platform. Most brokerages now offer commission-free trading and very low expense ratio index funds. The investing world has never been more accessible to regular people. Let me give you specific fund examples for the 3-fund portfolio I mentioned. These aren't recommendations, just illustrations. For U.S. stocks, Vanguard Total Stock Market Index, VTSAX, or equivalent, covers the entire U.S. stock market, over 3,000 stocks in one fund. For international stocks, Vanguard Total International Stock Index, VTIAX, or equivalent, covers developed and emerging markets outside the U.S. For bonds, Vanguard Total Bond Market Index, VBTLX, or equivalent, covers U.S. investment-grade bonds. Put these together in proportions matching your risk tolerance, and you have a complete, globally diversified portfolio for almost nothing in fees. Legendary investor John Bogle would be proud.
So when should you actually sell investments? There are legitimate reasons to sell, and they're rare. Reason 1, rebalancing. You sell some winners to buy more of laggards, returning to your target allocation. This is normal and healthy. Reason 2, life changes. You're approaching retirement and need to shift towards safer investments. You need the money for a major planned expense. Reason 3, tax loss harvesting. In taxable accounts, you sell losers to offset gains elsewhere. This is an advanced strategy. What's not a good reason to sell? The market is going down. I heard bad news. I'm scared. These are emotional reactions, not rational decisions. If your plan was good yesterday, it's still good today. Here's something liberating. Nobody can consistently predict the stock market. Not economists, not fund managers, not TV personalities. Nobody. There's an entire industry built on making market predictions. They sound smart, they use impressive charts, but their accuracy is barely better than random chance. According to decades of research, even professional forecasters get it wrong more often than they get it right. If they could actually predict the market, they wouldn't be on TV, they'd be quietly making billions. This is actually good news for you. If professionals can't beat the market by prediction, you're not at a disadvantage by not trying. Just buy index funds, hold long-term, and ignore all predictions. A bear market is when stocks decline 20% or more from recent highs. They sound terrifying, but they're actually normal and expected. On average, bear markets happen every few years. They last about a year on average. Then recovery follows. This is the price of admission for long-term stock market returns. Think of bear markets as sales events. Everything is 20%, 30%, 40% off. If you're regularly investing, bear markets mean you're buying at discount prices. This helps your long-term returns. The people who lose money in bear markets are the ones who panic and sell at the bottom. The people who gain money are the ones who keep buying or at least hold steady. Which one will you be? Every single bear market in U.S. history has been followed by recovery and new highs.
Every single one. The 2008 financial crisis saw markets drop over 50%. Terrifying. But within a few years, markets had not only recovered, but exceeded previous highs. COVID crashed markets 34% in March 2020. Within months, they had recovered completely. By the end of the year, the market was up for the year overall. This pattern repeats over and over. Crash, recovery, new highs, crash, recovery, higher new highs. It's scary while you're in the crash, but recovery has always come for patient investors. Your investment strategy should match your timeline. This is crucial. Money you need in 2 years should not be invested the same as money you need in 20 years. Short-term money, 1 to 3 years, keep this in high-yield savings or short-term bonds. You can't afford volatility when you need the money soon. Medium-term money, 3 to 10 years, a balanced mix of stocks and bonds. Some growth potential with some stability. Long-term money, 10+ years, mostly stocks. You have time to ride out any volatility, maximum growth potential. Match your allocation to when you'll actually need the money. Retirement in 30 years? Aggressive. House down payment in 3 years? Conservative. This is called asset-liability matching. I want you to understand something profound. Consistency beats perfection, every single time. An investor who contributes $200 monthly for 30 years will beat an investor who waits for the perfect moment and contributes $300 monthly for 20 years. Don't wait for the market to drop before investing. Don't wait until you know more. Don't wait until you earn more money. Don't wait for anything. Start now, stay consistent, and adjust later if needed. The friction of getting started stops more potential millionaires than market crashes ever have. Open an account today. Set up automatic investing. The exact funds matter less than the habit of contributing regularly.
Let me quickly cover the psychological traps that destroy investor returns. Knowing these biases can help you avoid them. Loss aversion. Losses feel twice as painful as gains feel good. This makes us irrationally avoid selling losers and overreact to temporary declines. Recency bias. We expect recent trends to continue forever. Market up 3 years? We expect it to keep going. Market down 6 months? We think it'll never recover. Herd mentality. We do what everyone else is doing. When everyone is buying, we buy. When everyone is selling, we sell. This is backwards. Awareness is the first step. When you feel a strong urge to act on your investments, pause. Sleep on it. Consult your written plan. Don't let evolutionary psychology override rational wealth building. Here's a strategy that dramatically improves investor outcomes. Write your investment plan down. Include your target asset allocation, when you'll rebalance, under what circumstances you'll sell, how much you'll contribute monthly, your long-term goals. Then, when markets crash and you're tempted to panic, read your plan. You wrote it when you were calm and rational. Trust your past self. The plan keeps you anchored when emotions run wild. Studies show that investors with written plans outperform those without. The act of writing forces clarity. The document provides guidance during crisis. It's simple but powerful. Your coworker who brags about his stock picks? Ignore him. Your uncle who knows the market is about to crash? Ignore him. Your friend who doubled his money on crypto? Ignore her. Anecdotes aren't data. For every person who got lucky on a risky bet, there are dozens who lost but don't talk about it. You only hear the success stories. The research is clear. Index fund investors outperform active stock pickers over time. But index fund investing is boring. Nobody brags about it at parties. So you don't hear about its quiet, consistent success. Be the boring investor. Decades from now,
You'll have the last laugh when your index fund portfolio is worth millions while the stock pickers are still chasing the next sure thing. Wealth building is simple math. Not easy, but simple. The equation is wealth equals income minus expenses plus investment returns. Increase income. Decrease expenses. Invest the difference. Let compound returns work over time. That's it. Every financial book, every advisor, every strategy ultimately reduces to this equation. You can optimize any of these variables. Learn skills to earn more. Cut unnecessary spending. Choose low-cost, diversified investments. But ultimately, it's just income, expenses, and returns. Simple math. Don't overcomplicate it. The people who build wealth aren't financial geniuses. They're disciplined executors of simple principles. You can be one of them. Here's an advanced strategy for serious wealth builders. Develop multiple income streams. Your job is one income stream. Dividends from investments are another. Side businesses, rental income, royalties, each additional stream accelerates your wealth building. According to research on millionaire habits, most millionaires have ownership stakes in businesses as founders, partners, or investors, not just a salary. Start small. Maybe it's a side gig using your skills. Maybe it's buying dividend-paying stocks. Over time, these streams compound. Eventually, passive income can exceed your job income. That's financial freedom. Let me explain a powerful concept called financial independence. This is when your investments generate enough passive income to cover your expenses, forever. At this point, work becomes optional. You work because you want to, not because you have to. This is the ultimate goal of wealth building for many people. The math. If you need $40,000 per year to live and your investments return 4% annually, you need a portfolio of $1 million. This is called the 4% rule, or 25 times rule. For many people, financial independence arrives surprisingly early. Not at 65, but at 50 or even 45. With aggressive saving and investing, you can buy back decades of your life. I want to shift your perspective on time. In our culture of instant gratification, thinking in decades feels strange. But that's exactly what wealth building requires. Plant seeds today that you won't harvest for 20 to 30 years. Future you will exist. Future you will thank present you, or curse present you. What will your choice be?
Every dollar you invest today is a gift to your future self. Every dollar you waste is stolen from your future self. Think about that next time you're about to make an impulse purchase. Wealthy people think in decades. Poor people think in days. Which mindset will you choose? Here's something powerful. The wealth you build doesn't have to die with you. You can pass it to your children, your grandchildren, and beyond. This is generational wealth. It breaks cycles of poverty. It gives your descendants opportunities you never had. It creates lasting family security. Imagine your grandchild graduating college debt-free because of investments you started. Imagine your great-grandchild buying their first home with help from a trust you established. Your actions today echo for generations. This isn't just about your retirement. It's about your family's future for the next 100 years. The stakes are higher than you realize. Enough theory. Let me give you exact steps to take today. Step 1. If you don't have one, start an emergency fund. Open a high-yield savings account and set up automatic transfers. Target $1,000 first, then build to 3 to 6 months' expenses. Step 2. If your employer offers 401k matching, enroll and contribute enough to get the full match. Don't leave free money on the table. Step 3. Open an IRA at Vanguard, Fidelity, or Schwab. Consider Roth if you're young. Set up automatic contributions, even if it's just $50 per month. Step 4. Choose simple index funds, total stock market fund, and total bond fund. Set your allocation based on your age and risk tolerance.
Enable dividend reinvestment. Then stop looking at it daily. Let me quickly tell you what not to do. These mistakes cost people millions over their lifetimes. Don't pick individual stocks thinking you'll beat the market. The research shows you probably won't. Don't try to time the market based on news or predictions. You'll miss the best days. Don't pay high fees to active managers who underperform index funds. Don't panic and sell during downturns. Don't invest money you'll need in the next 3 to 5 years. Don't skip your employer match. Don't carry high-interest debt while investing. Don't wait until the right time to start. We've covered a lot today. Let me leave you with this final thought. You now know what to do. You know about compound interest. You know about index funds. You know about tax-advantaged accounts. You know about the behavior gap. You know about staying the course. The information is not the problem. The knowledge is right here. The question is, will you act on it? Will you open that account? Will you set up that automatic transfer? Will you start today? The difference between wealthy people and everyone else isn't intelligence or luck, it's action. They took the steps. They started imperfectly. They stayed consistent through decades. They let compound interest work its magic. Your wealth is waiting for you. It exists in the future, built from decisions you make starting now. Every month you delay costs you money, potentially hundreds of thousands by retirement. Don't let another day pass. Don't let another paycheck go uninvested. You have everything you need. The markets are accessible. The index funds are waiting. The math is on your side. Your only job now is to begin. This isn't about getting rich quick. It's about getting wealthy certainly, slowly, predictably, inevitably. The stock market has made millionaires out of janitors and teachers and cashiers. It can make one out of you too. Start today. Your future millionaire self is counting on you.